The market certainly feels like it's lacking a bit of oomph at the moment. We did see the world stock index, the MSCI World, up near 2-week highs today. That's thanks to US President Donald Trump returning to the White House in a scene straight out of a Pyongyang propaganda video, landing from his Air Force One chopper and doing his best Covita impression on the balcony. We saw the JSE All-Share vacillating between wanting to get going, and then it just ran out of steam towards the end of the day. We ended down 0.59%. We lost 320 odd points on the All Share. 54,203 points is where we ended, giving back in most sectors. The biggest declines in resources and financials, down 1 and 1.2% respectively. Property down 1.1. The gold index down 0.9. So really nowhere to hide for investors at the moment. The Rand currently trading in a very tight range, 16 Rand 54 to the dollar. Lots to talk about though with Rob Towell, Portfolio Manager at Westhuizen Securities, and Mike van der Westhuizen, Portfolio Manager at Citadel. Rob, Trump Covita, not enough to spur this market though.
Not really. In the local front, Monday and again today, we didn't have a lot of volume. Today we had 15.9 billion that traded, so really thin volumes. And across the board, all sectors negative, with the banks giving back again. They had caught a bid last week, the banks, but they've given it back Monday, Tuesday again.
Why is that? What are you putting that down to? Was there just a bit of over exuberance towards the back end of last week, and people thinking, hey, SA Inc.'s finally going to turn, and then we just have a weekend to think about things and realise that hey, the ANC has decided not to disallow doing business with the state, so turning this thing around is going to take a little bit more than promises.
No, I think that the write-downs that the banks have done and the provisions are very big, and it's going to be a way up over the next few months to see whether these provisions are right. So I think the banks are going to be quite volatile. They tick up as people start to feel maybe the provisions are right, and then you get a bad story in, or you get some negative news on the economy and they come back down. So I think they're going to trade in a range, but quite a volatile, tight volatile range for the next few months.
Mike, how are you reading the market today? As I said earlier, it looked in the morning session like it was going to be a pretty soggy day. We then climbed into the afternoon, but late afternoon sold off again. And as we see, the US markets have opened pretty soggy as well, soggier than an Eskom coalfield in a high-felt summer. S&P 500 is down 0.1%. The Nasdaq down 0.5%. The Dow eking out a slight gain, up 0.1%. How are you reading it?
Yeah, I mean, definitely a little bit of a pullback from the uptick yesterday, especially strong S&P yesterday as Donald Trump emerged. The market there coming back up to where it was before we found out that President Trump had COVID. But obviously a lot of other issues flying around at the moment, and I guess mostly from a policy perspective, especially in the US, and the ongoing chat and debate about whether a fiscal plan can be passed prior to the election. So I think the market is waiting for some kind of catalyst to rally again. So hitting quite a bit of resistance at these levels.
It does feel like a bit of a yawn fest out there, Rob. What is that catalyst? What could be a potential catalyst? Or are we going to have to wait for that November 3rd election result?
Well, we could get a stimulus package out of the States before then. I think Pelosi was trying quite hard to get some type of deal through. And if you've got a deal through there, I think that would give a drive into the elections, and then you'll see a wait and see into the last few weeks of the election. So I think that will definitely be a catalyst. Not too much happening on the Brexit side either. That's also a bit of a yawn as usual. So I don't think that will trigger the market. So really maybe one or two numbers coming out of China this week, and see commodity prices can stay firm on the local front to see if we can keep our miners up. But other than that, I really think it's a stimulus package that we're looking for out of the States.
And Mike, just to add on to that theme out of China, it has been quiet because we've seen Golden Week holiday over in China and lots of local travel. I think over 500 million Chinese travel over that period from the 4th to the 8th of October. Just a staggering number, that. And a lot of concern at the moment about the Three Gorges Dam. It's been very rainy on the Yangtze River. That's up to its emergency levels there. And I guess the other big issue that markets will be watching is whether or not we'll see a spike in potential COVID cases due to all of this travel inside China.
Yeah, I mean, it's staggering. You're just looking at some of the photos, the aerial photos of the number of people out and about. And, you know, we've seen, China, from an economic standpoint, has rebounded very strongly. I mean, they were the first to come out of lockdown. You know, we've seen the economy opening up quite nicely. But, you know, if you just look at some of the first little bit of Golden Week, we're seeing a slight decline, well, not a slight, about 30% decline in tourism revenue relative to a year ago this time. So definitely a bit less travel, and also in terms of the actual spend per tourist has actually slowed quite a bit as well for what we've seen. But I mean, versus the sort of holidays we saw early on after China opened up to now, you know, the spend, looking at the high frequency data, the spend is coming back quite nicely. But still a way to go.
Still a way to go, and we'll see a lot of that hitting the tapes towards the back end of this week. Will travel and luxury purchase get anywhere near to last year's levels? I think that's what market participants are going to be looking out for. And then, Rob, Brent, the other big story, I guess, at the moment, 5% up overnight and a further 2.3% up today on a bit of a supply crunch happening in Norway. How sustainable is that?
I think there's also a hurricane coming through the Gulf as well. So, and then there's I think the weekly numbers are coming through for inventory. So I think the hurricane in the Gulf looks like it could be quite a big one. So that's, I see Chevron has pulled all of their employees off the Gulf. So I think there is a bit of a supply issue. So short term, it's good. It's good for Sasol. Sasol needs every bit of help it can get at the moment. So oil price, you know, 41 and above helps that Sasol price stay above 120. And I think you can see it there for a while, depending on how bad the strike also gets in Norway. And Saudi also saying, you know, they need, Goldman Sachs saying that Saudi used a $50 Brent price to do their budgets. And, you know, the oil price is not there yet. So, you know, I think that it is possible to see Brent and oil above 40 and moving up towards 50 over the next few weeks.
Yeah, Sasol and Sasol shareholders need whatever they can get following that Linden Basel deal announcement, clearly showing that Sasol approaching this transaction not from a position of strength, shall we say it. The market underwhelmed by the price that asset's going to be fetching. But I want to stay on the strike issue, Mike, and tomorrow we've got Cosatu embarking on mass strike action as part of this ongoing dispute with government. If we cast our minds back to the February budget, the finance minister sprung it on civil servants that they were not going to acquiesce to the final year agreement, which was part of a 3-year agreement, because of the parlor state of our finances. And with COVID, it's very, very difficult to sympathise with the public sector in this one. The question is, how many civil servants have had wages cut or been given retrenchment notices, or have had to in any way, shape or form share the pain with the rest of us?
Yeah, I mean, that is true. It is a kind of sort of a double standard, or you know, a different circumstances faced by the private versus the public sector. And unfortunately, I don't envy the poor finance minister who has to come up with a plan and speak later this month in the NTBPS. I think that Labour is obviously going to push back as much as they can. And I don't foresee that government is going to be able to push back hard enough, at least in the short term. I would like to be surprised on the upside there, but it's a mammoth task to get Labour to play ball in a big way.
Will anyone notice, Rob? Will anyone notice that Cosatu goes slow if they're all going to stay at home? What's going to change?
Yeah, it'll be interesting to see. I mean, I think people still obviously do go into the office, and you'll guys. Picking up the rubbish, etc., like that, you will notice that they're not in the street. So, yes, it will make a difference. And, the economy doesn't need it. The economy doesn't need it at this stage. So, at some point, you have to have some solidarity with the whole economy as a whole. And it would be good for, Cosatu to say, we're going to make a stand. We'll make a stand maybe in a year's time. we're not letting it go, but for now we're going to let the economy run. That would be quite nice, but obviously that's too much to ask.
Oh, Cosatu not reading the economic mood of the country at the moment well at all. Where I will give plaudits to Cosatu, along with business, was they were the two social partners calling for an outright ban on politically exposed persons, PEPs, doing business with the state. And judging by the president's YouTube address following that ANC Lekgotla, which was broadcast last night, he's backpedaling on that. So he's going to consult more broadly inside the party before they agree to make that law. And it's not a good look for a president who's said he's drawn a line in the sand when it comes to corruption, for that line in the sand now to all of a sudden start to be seen to be blown away. We will be following that quite closely. Still early days on that one. And then a very interesting note, Rob, that I saw from Investec on tobacco fire sale. Tobacco stocks deeply discounted and out of favour at the moment, and with dividend yields at double the UK market average and resilient earnings. Let's face it, they do sell an addictive product. Now, why are they out of favour at the moment? I mean, one can certainly see regulation being a big headwind maybe 10 or 15 years from now, but right now?
I think a lot of the time is that people think that smokers are going to stop smoking. Now, as you get a bigger portion of the economy that doesn't smoke, it seems more and more strange that people do, but unfortunately that's what they do. And you just keep seeing incredibly good numbers come out of the tobacco guys. And, their free cash flows are really, really strong, and therefore they can pay these great dividends. They're in markets that are in emerging markets a lot of the time. And people do like to smoke cigarettes. It's similar to alcohol. And I think that, it's part of, sustainable investing that some of the big funds have stepped away from oil and have also stepped away from tobacco. And, you're not seeing the same drive for returns from investors out of those companies. So they are very cheap at the moment, and they show a lot of value. Do they get a bid? Do people come back and buy them? I'm not sure. I think what you're going to get is a really well-paying dividend stock that has some upside.
Yeah, and you've obviously got to factor in as well your personal preference around your ESG weightings in portfolios and whether or not you want to commit to companies like that. I'm a big believer in freedom of choice. If people want to smoke, if people want to drink, it's their choice. If I want to get dividends, it's my choice. And I'm certainly not seeing many that are offering these sorts of yields out there at these valuations. So a very interesting story that at the moment. A great note out by Investec. Mike, on the economic data front, what are you going to be watching out for this week? Obviously, lots of PMIs out. We've had the SARB quarterly bulletin. There's lots of interesting stuff in there that we're busy getting our teeth stuck into. What's on your agenda?
Yeah, definitely keeping an eye on the PMIs. I mean, we've seen a nice rebound in PMIs globally over the last couple of months, especially since the bottom there in March. And, a bit of a divergence between some of the developed markets and emerging markets, just to see some more strength come through there. Although, the most recent economic data in general has sort of, the momentum in terms of the recovery has started to peter out a bit. So just to see there whether there's a sustained strength or whether we might see a bit of a soft patch. Granted that most of the data we've seen now has come off a very low base in the rebound. And then obviously what's always on everyone's mind is the US employment numbers, and those have also, after also a strong recovery, have started to flatten out in terms of the trend there. So that's also very important to look out for, given that the consumer in the States is a very large part of the economy. So
yeah, absolutely. I was just going to say that is going to be a key data point, and we've also got the Fed minutes as well. Mike van der Westhuizen is Portfolio Manager at Citadel, and Rob Tyrwell, Portfolio Manager at Sasfin Securities, with your view from the market.